have our sub-advisor here, Muzinich. We have Jens Ernberg, who's the co-head of private credit, as well as AAM's Todd Kurisu, who's a portfolio manager, and Leah Savageau, who's a senior fixed income credit analyst. They'll be going over how they manage risk within the private credit space with all these headlines coming out. Looking forward to an insightful conversation. And with that, I'll hand it over to moderator Todd.
Thank you, Matt. Are we okay? Okay. So I want to start with an administrative note first. In the original agenda, this session was entitled Private Credit, Key Issues Creating Stress in the Sector. So after meeting with Jens and Leah, we all agreed that that was a bit draconian, especially after following General Bellin's lunchtime pep talk and after following Rosemary's AM Best Outlook. So we changed it a little bit. So in your agenda today, it says private credit, separating signal from noise. So the goal for us here is really just to kind of frame and clarify the issues that have come up over the last year, and then just really frame how this fits in for insurance companies. Jens is on the front line of this market as a decision maker in private credit, and Leah is going to help us frame the fundamental considerations for insurance companies. I also note that in the agenda, this is the last session of the day, so first off, thank you for hanging in there. But I also note that that means we're the only thing keeping you from drinks and dinner, so we'll be sure to stay on schedule. With that, I'm going to begin by asking Jens, just to start us at a high level, and just define exactly what private credit is and what it isn't.
Sure. Well, thank you all for sticking around. It is late. And there's been a lot of talk of private credit. But private credit means a lot of things to a lot of different people, right? It's sort of been a monolithic term to describe not public credit. I think people, generally speaking, have aligned their thinking around private credit being the same as direct lending, which is one of the bigger categories within private credit. But private credit expands beyond that, of course. There's private high yield, there's private investment grade, there's private asset-backed lending. So really it's direct lending of different ilks that is not executed by commercial banks or that's not traded on markets. So it's really just a private asset class, but it covers a lot of different things. I don't want people to think that private credit is one single thing, direct lending to corporates, but rather it segments into a number of different buckets, all with different sort of risk-return profiles, obviously.
Jens, let me just ask a follow-up question on that. A lot of investors have traditionally invested in private placements.
Yep.
Can you just distinguish for us the difference between private credit as an asset class and what we think of as traditional private placements?
Well, private placements and private credit are synonymous, in fact. I mean, private placements were historically how insurance companies and other non-traditional lenders executed on private credit strategies. So they were, by the name, right, private placement, they were privately placed investments that ordinarily would have been addressed by the public markets, but for whatever reason, whether it be size, complexity, circumstance, didn't allow them to be executed in the public markets. So that I think it's sort of semantics in terms of those two, but that was historically a small kind of corner of the market. You've expanded, sort of the private placement market, if you will, has now expanded across the private credit spectrum or the entire credit spectrum. So think of these as all kind of private placements of product that historically had either been executed by banks or by commercial institutions or professional investors.
So can we think of it then as the kind of the natural growth of this asset class as over the last couple decades?
Yeah, look, I think the genesis of the asset class is really, it's been around for a long time, and like I said, this private placement market has been a decent-sized market over time. The real sort of accelerant that brought about a growth in private credit was really the great financial crisis, right? So the GFC really took banks out of the market. So much of what's happening in private credit, just because direct lending is one of the bigger parts of the asset class, commercial banks were really where direct lending was being executed pre-financial crisis. I mean, it had been moving along the spectrum, so CLOs, obviously, and insurance companies had picked up a big part of the private direct lending asset class, if you will. But the real catalyst for growth in the private credit asset class, the way we think of it today in terms of direct lending, really began that catalyst was, the GFC was really the catalyst for that. So they came in, alternative lenders came in and really replaced the commercial bank market initially. And that was where it all started. And then it has grown across the spectrum of credit to encompass high yield, investment grade, asset backed. So it's sort of been a land and expand strategy for the private credit asset managers to bring the same technology, if you want to call it that, to different parts of the credit market.
Okay, thank you. Leah, obviously we've seen from the different panelists today that this is a hot button topic for a lot of investors. Going back to last October, we had a couple of notable bankruptcies. Chris Lowe referenced that in his comments this morning. Jamie Dimon famously warned us that when you see one cockroach, there are often more. So can you just give us a quick summary of what happened there with First Brands and Tricolor?
Yeah, so I think Chris Lowe hit the nail on the head in terms of the fact that it wasn't necessarily a traditional credit story, they were fraud stories. And I'll start with Tricolor. For those of you who aren't familiar with Tricolor, they're basically a used auto retailer that had a subprime lending arm. The way they funded themselves was through bank warehouse funding, where they would get funding from the banks and ultimately make the loans and build inventory so that they could ultimately issue ABS and repay those warehouse loans. They had been active in the ABS market actually up until June of last year, 2025. They had issued their 17th ABS. 2 months later, they were filing for Chapter 7. And basically, what they uncovered was the fact that they were making fictitious loans. Receivables, the performance on the loans were not being reported correctly. And they were also double pledging across warehousing and ABS. So it was an entire fraud story that was ultimately uncovered, allegedly, I haven't been able to corroborate this, by junior analysts that work at JP Morgan. But it was basically taking a good look at the collateral reports and saying, hey, this doesn't make sense. First Brands was a little bit different, but similar in the sense that it ultimately ended with fraud. They were just a leverage finance buyer that was doing the traditional leverage finance play of being a roll-up company, buying small little auto parts dealer companies across the United States. They were tapping the broadly syndicated loan market to fund that, and they were highly leveraged. It's a traditional play that we see in the broadly syndicated loan market all the time. Where they got into trouble was the fact that they were also doing receivables factoring and trade supply chain financing. And they had taken those off balance sheet. They were also still collecting and acting as an intermediary between paying those assets that were pledged to the financee. And they weren't necessarily, they were just collecting the cash, but they weren't basically recording the obligation there. So their hidden leverage, so to speak, was much higher than what was just getting tapped in the broadly syndicated loan market. And ultimately, what we found there, once again, was that it was fictitious, invoices, double pledging, the same sort of things. So getting back to what Jamie Dimon said, I don't think he was wrong, and directionally he was right. Shortly thereafterwards, I'm sure everybody's well aware of MFS. That was a UK mortgage specialist. They did buy-to-let and bridge financing. They had hit the market many of times, had relationships with Barclays, HSBC, Apollo through their Atlas, and other banks as well. But they also were double pledging assets and ultimately engaged in fraud. And so I think the big key takeaway here is that fraud persists or comes to light when you have ample capital, ample liquidity, and you have highly competitive situations where, underwriters are trying to get deals done and they're competing heavily on that. So I think, cockroaches are right. We could see more. But I think it also leans into what's going on with underwriting, because we tend to see the same thing with underwriting, that underwriting tends to get a lot more loose and slack when there's abundant capital, when there's loose liquidity, and people are competing for deals to put capital to work. And so I think, we could start to see some weakness there and kind of tie it into a systemic sort of discussion. I don't think we're in a systemic situation here, but I do think you're going to start seeing more dispersion in performance between some of the underwriters, whether that be in direct credit, so larger, middle market BDC, upper middle market BDCs, or smaller subscale players in the same market. You'll start to see some distinction between the underwriting there.
Thanks, Leah. So Jens, let's take a step back again. And since last year, we've been reading about a lot of headlines with different private credit funds capping redemptions and different liquidity issues, including this week. There was announced that Morgan Stanley capped redemptions on one of their funds. So can you just walk us through what that means, or how does that happen for investors?
Yeah, I think what you've created is a classic, mismatch in assets and liabilities, right? We in the private credit world are operating with very illiquid assets. It's similar to what you saw at the financial crisis, right, where the expectation is that you can unload illiquid credit very quickly without damaging or without losing money, right? And so I think as investors were seeking ways to raise more capital and broaden the pool of investors, they started to address a market that's very keen on liquidity, the retail investors, and started designing products that they felt would be more easily consumed by the retail market, right? Retail investors value liquidity. So they were selling a story of, hey, here you can get the pickup in yield, a big piece of which, by the way, comes from illiquidity premium. So part of the reason you're earning more in the private markets is because you can be patient and take advantage of that illiquidity. And now you're selling liquidity against these very illiquid assets. I mean, trying to sell a loan in a market, especially a market that's challenged, is not going to happen unless you're taking a significant loss on that loan, right? So the structures gained, not surprisingly, like a lot of other asset classes that catch fire, gained interest from investors. They believed they could make very healthy, high-yielding income and still have and retain that liquidity component in their investment portfolio. And when things started to go sour and investors ran for the door, and we can talk about why that happened, but when they started to call their capital, they had misunderstood the limitations of that liquidity. So these funds, there was some recognition that you were never going to be able to unload all of the fund in one go. So they have typically limitations on what you can redeem on a quarterly basis. Typically, that's been about 5%. And on top of it, that ability to redeem is also subject to some discretion at the manager level. So the manager can decide, based on what they believe is in the best interest of investors, whether they should or should not execute on that redemption. So in other words, if the market's tough and you can't monetize these assets without incurring a massive discount, the manager could say, hey, it's not the right time, sit back, wait, we'll deliver money when you need it. So that I think was the sort of genesis of the issue. We can talk about why people started running for the door, if you'd like.
Well, Jens, can you just clarify? So I think I heard you say that this is focused on retail-oriented investors. So does this affect institutional investors in terms of the redemptions or anything like that?
Well, it's available to all investors in these funds, right? So the BDC market is kind of where this is happening. It's really happening in the private BDC market. Obviously, in the public BDC market, you're buying equities in a BDC, and you have liquidity. You can sell your equity whenever you want.
Let me jump in. So you brought up BDC, and we've heard that acronym a number of times today. And so in the private credit space, what we know is this can become like an alphabet soup of acronyms. So can you just describe for us what is a BDC and what is the purpose of it?
Yeah, so the BDC is a vehicle really designed to attract capital to middle market companies in the US. So it was vehicles that were supported by the SBA and the government to try and attract money and build capital for lower middle market companies that couldn't access the public markets. And there were features of this structure that were beneficial to investors as well as to the managers. Part of it is it's a corporation, so it's an investment company that pays taxes, that basically blocks taxes. So it functions like a REIT. So as long as you're distributing over 92% of your income, that distribution is effectively tax-free to investors. And so it was a way to attract investors and capital, mostly capital, into the lower middle market to support the economy, growth in the economy. And for the investors, one of the benefits for the investors of these vehicles is they are regulated by the SEC. There are disclosure requirements. There are requirements around diversification of the portfolio. Half your portfolio has to be in positions that account for 5% or less of the portfolio. So there's investor protections around the regulatory structure that these are operating under. And they became sort of popular vehicle, and they promised, and because they distribute all their income, they promised healthy income for investors on a relatively tax advantage basis, right? So that's sort of the genesis of it. It's evolved from historically being mostly a publicly traded vehicle to there's a large private BDC market. So these are non-traded. They're still reporting, operating under the SEC. They're still reporting their numbers to the SEC. So there's public information on the portfolios, underlying assets. There's MD&As. There's some transparency around the portfolio. There's valuation rules around how you value the assets, et cetera. So you can find all the information on these private privately managed BDCs. But that market obviously is not traded, so you're effectively committing to those vehicles on a permanent basis. There is some promise loosely within the BDC docs that they will provide liquidity at some point at the discretion of the manager by either taking them public or selling them. But in effect, they are permanent capital vehicles that could be alive as private finance companies forever, effectively.
Okay, thank you. I neglected to mention in my opening comments that we welcome questions. So to the extent that we trigger anything with anybody, feel free to jump in.
Isn't the answer to fix these private BDCs? These are basically closed-end funds that if you want liquidity, you trade at a discount. And I think the other thing I've seen in the private BDCs is it tends to attract a smarmier kind of manager who can get away with like the things you just described. I mean,
Well, I think just to be perfectly clear, there's really three types of BDCs. There's the traditional, what everybody probably knows as a BDC, public BDC, where the shares trade on an exchange. So you as an investor, yeah. Then there's the private BDCs, which have been around for a long period of time that were traditionally only institutional. This third generation is this retail, which is kind of a hybrid between the two of them. They only started, the genesis of them was really 2021. And the push there was, it's kind of the private equity alternative manager sort of ethos right now, is to democratize alternatives, whether it be private equity. But I think that's an important distinction.
Yeah, I think actually the emergence of this liquidity feature is more recent in terms of trying to attract the retail investor. I think there was always if you looked at the publicly traded BDCs and the roster of investors in public BDCs, there's a very small component of institutional investors involved in publicly traded BDCs, in part because the equities are generally not big enough to fit most large strategies or any index, right? So I think your impression on the sort of smarmier managers, I think in the 2000s, pre-GFC, there were a few of these vehicles that were run by sort of mercurial characters, if you will. And they did attract, the vehicles themselves were compelling because they were permanent capital vehicles, and the fee structures at that time were kind of 2 and 20. And they had the sheen of institutionalization because there was the SEC oversight. But the reality is the investors they were attracting were largely retail-oriented investors. And those vehicles, all right, and by the way, they were selling these, they were basically charging investors the distribution cost as well. So you're coming in at 96 cents on the dollar, right? You're paying 96 cents for a dollar. Sorry,
if you think about Jens, that we started this with traditional private placement market. So Rosemary was here. She would be familiar. Phoenix Home Life in its day had $4 billion, as I recall, on the books. really well researched. It gets paid 50 basis points more for illiquidity, but it's the same quality as public debt with an indenture versus the stuff that's now sold on the market is like a software company that might have some revenues. I mean, I'm just saying, like, it seems to me the issue might not be the structures, it might be.
You're thinking about the underwriting, whether there's really a problem on the underwriting and structuring side of the loan. I mean, that's totally a different question, and that could be pervasive. It's not a reserve to BDCs, right? It could be, you could be talking about it for any manager, right? In terms of folks being focused on software in lending, for example, right? If that's what you're getting at.
Yeah, it sort of seems to me that that asset has much more credit risk to it per unit than what I think the private placement market.
Well, and I think, but they're a little different, because when you look at what BDCs are investing in, you're absolutely right. They are lower quality, higher risk. I mean, if you look at the underlying credit, they're generally going to be the equivalent, if they were rated low single B minus, triple C plus. So yes, you're absolutely right. But I don't think it makes that a fair comparison to the regular private placement market, because in general, that's going to be more investment grade, or presumably more investment grade, right? Yeah. But one other thing I just want to kind of also make clear about this next generation is that one of the things with the redemption feature that it solves for is on the institutional private side, you need a liquidity event to happen for the fund to basically, for investors to get repaid their capital. And we just saw this with the Blue Owl situation in December. That was a private fund. There were 3 options when it came time for that to end. They could either merge, they could IPO, or they could wind down. Well, they couldn't IPO because of the market at that time. They tried to merge. That didn't go well because merging would have taken a 20% haircut for shareholders that were part of the private fund. So they chose to unwound. And so what these retail vehicles, we're trying to solve for is being potentially more permanent capital than what you would see even from the institutional side, because with the redemption feature, I think what they were hoping would happen is that they were offering retail investors an opportunity to get out and sort of turn, right? And we can probably get into this a little bit more with the redemptions, but where we're seeing a distinction between who's getting the high redemptions and who's getting the lower, there's a lot of things going on there. But one of the things that's, up top is how seasoned the investors are in that fund. If that fund is old, call it one of the new ones that came out in 2021, so not terribly old, but old in that sort of cycling, you're seeing higher redemptions in those. Because naturally, those equity investors, those retail investors, were gonna move out regardless. Because their horizon's just over whatever they're gonna, so I just wanna make sure that distinction's clear.
Point at all, though, it would be that a traditional closed-end fund mechanism would have solved that problem for retail investors. Maybe not elegantly, but in reality, right? If a lot of people want liquidity, you can buy NAV for 70 cents.
You can. And there's certainly the arbitrage that you could have done by redeeming your shares out of this perpetual vehicle at par and then presumably going and buying the discounted NAV. But I think the attraction to this is that retail investors didn't want to deal with the volatility of a NAV that's traded on an exchange. So I think that was sort of the attraction, so to speak, for these ultra high net worth.
But the closed-end fund and liquidity component requires a healthy secondary market, right? Even buying a discount. And that has emerged, right? Since private credit, much like private equity, right? You have the emergence of a very healthy secondary market that's quite competitive on private equity.
Yeah, I would argue, I mean, I'm one person, but I would argue when the government took prop capital and things like that that supported those markets for like everything from small cap markets to like closed-end funds, and we've closed it down. We've created this trap that, sorry, the best way to give retail investors liquidity would be they can go sell it and there's a buyer and a seller. And ideally, markets move to an equilibrium on that. So if there's a lot of people who want out of Blue Owl, they might trade for a big discount, but eventually somebody says it's too much of a discount. Whereas the asset liability mismatch that Todd was talking about, every time there's been an asset liability mismatch, if you read the guy who wrote about 500 years of manias, panics, and crashes, amazing book, right, Todd?
Yeah.
Every one of those was a combination of excess liquidity in the system and then something like panic caused by the lack of liquidity. So it systemically, I think it's bad for the private credit market, because I do agree with Mike Arrighetti, what he said a week or two ago, that on balance, they're not doing leverage buyout. It's a small part of the portfolio. They're doing what Leah said. They're fulfilling what the banks used to do, but we've so clobbered the banks in this country that they've been.
Yeah, look, I think Arrighetti's talking in his book a little bit. They're doing a ton of leverage buyout financing. In fact, that's the lion's share of what the area of this BDC portfolio is. They have moved, much like Apollo, into investment grade, different strategies, right? So folks have expanded their universe or addressable market by moving into adjacencies on the private side. So there's private high yield, there's private investment grade, which is sort of what you're talking about in terms of private placements. Those are the same private placement things you're talking about, where you're talking about high quality investment grade loans probably can't be addressed in the public market and therefore addressed in the private market at a slight premium, right? But Arrighetti's book is, I would say his area is like, the big fund is 80, 90% leveraged.
He brings up a good point with respect to systemic risk. So, and Rosemary from AM Best brought up systemic issues, or she at least acknowledged that it's not a systemic issue from AM Best perspective. So let me ask each of you, do you think that private credit or the issues that we're seeing in that liquidity space for retail investors, can that become a systemic issue?
I mean, I think you never say never, right? Things start in some corner of the market.
But
and
if I
they
forced you to
infect.
just say yes or no, would that be a no?
I would say no.
Okay.
It's not a
Leah,
systemic
yes
risk.
or no?
I don't think we're there yet.
Okay.
I think, and it kind of speaks to maybe a what keeps you up at night sort of situation where, in my opinion, I'm less concerned about what goes on the asset side of these, because in my opinion, having worked in leverage finance before, you kind of know how this stuff kind of works. You're buying highly leveraged companies that have a single B sort of credit profile. You're going to get defaults. There's no two ways about it. The macro environment turns, a single B, triple C, you're going to have defaults in that space. It's just the way it goes. If you don't have defaults, if a manager says they're not having defaults and that's what they're focused on, they're not taking high yield risk. Alternatively, they're selling the bonds before they get into a workout situation because they can't simply do a workout, and they're probably leaving money on the table. So I think, that's not what's keeping me up, and I would actually say, some of this panic that we've been seeing with redemptions, while it's been, headlines related to software, the asset quality is actually held in pretty well, and you would expect that because a lot of these loans were underwritten maybe last year. If you're having a problem with a loan that was underwritten last year, I don't know, that's probably not good. So I'm not saying that there won't be problems, but the loans are just not seasoned enough to actually have problems there. But what's been keeping me up more at night, and I think where it becomes a systemic issue, is on the funding side of things. We've had these waves of redemptions. We're getting more redemption news that's coming out of the market now. If you look at the market in general, who's reported now, redemptions are actually higher than where they were in the first quarter. The market really hasn't moved because of these caps that we were just talking about. And everybody's happy about these caps because what does the caps do? Well, it stops them from having to liquidate 20% of their portfolio to fund redemptions, which basically means that as long as they're getting inflows into their portfolio, they can probably pay the redemptions. They also have interest that's coming off of the performing loans. There's a lot of options that they can flex. Just in terms of organic earnings generation, assuming that we stay in a more stable macro environment that we're in. But if those inflows don't come in, now they have to borrow. Now they have to get leveraged. Where are they going to go? They need to go to a bank. They need to get creative with their financing. And what we've seen just in the fund finance space has gotten complicated. There's a lot of hidden leverage there. It's still new, so I don't think I'm worried about it yet, but I do think the more complicated that gets, the more customized, the more hidden leverage that you get in that sector, that's where it becomes a problem, because the more complicated, the more hidden leverage, the harder it is to roll over, the more likely you're gonna see funding evaporate. And it's great to see all this diversification, whether it be CLOs, rated feeders, rated note feeders, all these sort of NAV financing, all these things. It's great diversity, but we all know in times of stress that diversification tends to become everything becomes really correlated, right? So you lose access to all markets, you're unable to roll over your funding, and that's where I think I start thinking more that we could have problems down the line.
My question is really around systemic. I mean, this is not a huge asset class, right? It's $1 trillion or something like that, right? And the exposure of systemically important players in the financial market, namely banks, insurance companies to a degree, banks are exposed through leverage lines for sure, but those are pretty conservative. 2 times levered, you've got a lot of asset coverage on those. So that's a pretty low risk proposition. I don't see this infecting bank liquidity and having runs on the commercial banks that could create real systemic risk. Insurance companies, pension funds are exposed, but what is it, 5% of their portfolio, maybe? So is a loss of the whole thing, which is inconceivable, is that gonna drive a system?
So Jens, so Leah teased my question. So I want to ask you, as co-head of private credit for Muzinich, what keeps you up at night with respect to this asset class?
To me, I think, the macro picture is challenging. I think, look, the interest rate environment, I think people have been waiting for capital velocity to increase, and you've had a lot of factors that are challenging for corporates generally, right, happen in the last several years, between interest rates in a floating rate asset class going from 0 to 5%. That already is impacting your cash flows. You had inflation that picked up and got to close to double digit for a period of time, and now you're running at 4% above that already heightened base. So that's another thing that's hurting your cash flow generation potential. The supply chains are getting deconstructed, and I fear there's more pain to come in that sort of deglobalization process. So to me, the macro story and the rate challenges and what that means from a capital velocity perspective is amplifying the risk. So a lot of the reasons, from my perspective, the credit environment today would suggest that rates should be widespread, should be widening, right? I think the risk environment is pretty challenging, but because there's relatively little new capital formation, in part because aside from the massive investment on the data center side, the economy, absent that, is not growing that quickly, and there's not a ton of capital formation. And so you're seeing a lot of capital that was raised for this asset class with not a lot of growth of demand, and so spreads are tightening because there's too much supply chasing too little demand. And I think that's today is creating an underpriced risk profile.
Let's pivot a little bit, because I want to make sure to get this question in before we run out of time. But Jens, can you just help us understand the difference from an underwriting perspective, the difference between private credit and the public markets?
I think the most important difference is the time you have to underwrite an opportunity. So, a typical public transaction, you have very limited time to put in your request for an allocation, to provide any sort of commentary on the documentation, and be involved in the actual underwriting, meet with management to get, to get a read on if they're fraudulent or not.
Are you able to put more covenants in those debt packages?
Well, depending on where you participate, right? It's all dependent on competition. And as Leah was saying, as the markets get more competitive and there's more liquidity available, people fight on terms, and that's where you see erosion around investor protections, on rates, on everything. And so I think we've been through a period during the ZIRP period where people got very loose with underwriting because ZIRP kind of frankly hit a lot of, made everyone look like a genius investor, right? And so I think we're coming off a period where people, and I think that's part of what is generating the fear around the asset class, is that there was this period from 2015 through 2022, 23, where it was a food fight to get deals done and commit capital and deploy. And now you have portfolios of loans that are underwritten on a very accelerated basis with competitive terms and not a lot of investor protection. So a lot of the low leverage buyout deals are covenant light.
Right.
So there's
no
signal.
Leah, let me ask you. I want to make sure to get this in, but from an insurance company perspective, what factors should they be looking at with respect to private credit as an asset class?
Yeah. So I think the interesting thing about what we're seeing on the insurance side is that private credit is really a tool for portfolio construction. It enhances diversification, lowers volatility. There can be structural protection. Structural protection, inflation, things of that nature. And that's just not my framing. That's actually stuff that came out of the recent BlackRock Global Insurance Survey. The top 3 reasons were diversification, inflation protection, and risk-adjusted returns if it made sense. So I think that's generally how insurance companies have been playing in this sector, or have been thinking about it. And then, what was...
So let me follow up on that then and ask you, as an analyst, when you started covering this space, what was the one thing that surprised you?
I think, this BDCs and direct lending, that's kind of the vertical that I focus the most on. What surprised me the most is that this direct lending BDCs have been around since 1980, but they didn't really start growing in earnest until probably, as John's alluded to, the financial crisis, particularly when they came out with guidance on leverage lending. That really pushed a lot of that lending out of the banking sector and created the BDC market. Within the past 5 years, pretty much since 2020, the market has grown probably 5 times, partly because of what we saw with the retail and just, the grab for, or the need for it, especially the anticipation of what we were thinking was going to come out with Basel III, the next round of Basel III. But I think
those are the bank regulators, so people.
Yeah, it's a bank regulation. But, after the bank crisis of 2023, Silicon Valley and such, there was a real push to put more bank regulation through, raise capital requirements, more liquidity. They were pretty punitive when they were first proposed, and that kind of created a bigger avenue and more opportunity for private credit, hence what we saw with the retail. Try to grab that already, and establish yourself in the market. So you saw a lot of BDCs come about because of that. So I think that's just how new it is, despite how old it is because we're just getting into more growth, different versions of it. The BDC 3.0 is what I call it with the retail, and now just more fund finance that's coming out. So I think that's kind of the surprising, is how old it is, but yet how new it is.
Thank you. Jens, one last question for you then. Put yourself in the shoes of an insurance company CIO.
You're supposed to ask me the surprise question.
Yeah, exactly. But what one thing surprised you when you started investing in this space? Or if I'm a CIO at an insurance company, what's the one thing I should be aware of?
Those are two different questions.
It is.
I'll start with the surprise, just to make, because that was what I was prepared for. But to me, it's just the ingenuity of the U.S. capital markets, right, and how private credit has grown from virtually nothing to this massive asset class, and now continues to expand by virtue of product design, right, to meet retail investors, by partnering with insurance companies to generate, endless fundraising capacity out of premiums. It's just kind of amazing to behold how ingenious and industrious the U.S. capital markets are. Mm-hmm. But from a CIO perspective, I think going back to Leah's comment, I think what you are going to find is, I think, a pretty disparate outcome in terms of returns that people generate. I think there was a period of very loose underwriting across the board, and I think now people are being truly tested, and I think it's manifested in this general uncertainty and folks fleeing from these vehicles and trying to get out because there is concern. And so I think you'll find a period here where, to quote Buffett, where the water's going out, we'll see who's wearing bathing suits. But yeah. I do think we are now being truly tested, or the asset class is being tested when it hasn't been for 15 years, right? It's been an easy asset class that you could build a diversified portfolio. And diversification will solve a lot of that problem. I think people have grown to scale and diversity where even meaningful defaults will not really impact them. But that's, I think you'll start to see real disparity in outcomes.
Thank you. We've left time for one more.
Just want to follow up a little bit on the insurance thing again and what insurance investors should be thinking about, because I think it ties a little bit into the previous presentation. It's just honestly, when we think about it, it doesn't meet the liabilities. And I think that really that's where it starts and stops. When you look at the charts that AM Best had up, the bigger allocations were in the life. And obviously that grew with the annuity business as well. But it really starts and stops with, does it make sense for the liability profile? Because it really, when you look at it across all insurance segments, it's really, really challenging to have a liquid assets when you do not have predictable liabilities, or you have a catastrophe or sudden cash needs, or really, really short duration liabilities that you have to be thinking about. So I do think that's where it kind of starts and stops. The other thing is just, what are the structural considerations with those bonds or the notes or the investments that you're thinking about? And ultimately, what does it mean from a capital treatment perspective? There's many different ways to get exposure to the same thing. Fortunately and unfortunately with private credit, you can get indirect BDC exposure by buying the bond. You can also do direct LP investing, and that will be a BA. There's just so many different ways for insurance companies to get the same exposure that you're not necessarily committed to one way. But those are kind of the things that I
do think that's critically important. The sort of the assumptions you make around what the asset class is going to deliver, right?
Yeah.
So there's the very predictable income ones with very low conservative levered vehicles, right? That you sacrifice some yield, but you're going to get the income, and that'll satisfy, possibly certain obligations. But you go into distressed and opportunistic credit, that's a much more volatile return profile. That's more of a total return play, right?
Yeah.
So you're not satisfying near-term liquidity issues with that side of your portfolio, right?
In closing, I note that Rosemary with AM Best put up a slide that showed the different strategies in private credit, and she listed 15 different strategies on there. And so, obviously this is a very deep and broad asset class, and so we think there's opportunity for, in certain instances in the right situations. Hopefully we clarified what some of these issues are, what private credit is and what it isn't. And potentially how it fits in insurance company portfolios. And with that, thank you all for hanging in there, and we'll see you guys for a night at the museum.
Thank you.